Howdy, Jacob here. Today we're looking at the Walt Disney Company in the entertainment industry, founded in 1923. I presume everyone on this planet has really heard of them. 160 billion market cap on 194 billion enterprise value. Their growth in revenue is fairly impressive. 49 billion in 2014 to 89 billion in 2023. So almost doubling over the last 10 years with sadly gross margins down quite a bit. It looks like COVID really dampened the margins on the gross and operating side. So operating margins were as high as 25% pre-COVID and are now just 10%, and gross margins were as high as 46% and are now just 33%. So their business model has changed a little bit with Disney Plus coming out. I don't know. Let's see. When did Disney Plus come out? In 2019. Okay, so just before COVID, and their growth has been absolutely crazy. I know recently it's slowed a bit, but it was, the biggest. I don't know. It might be the biggest streaming service either way, but definitely a huge streaming service. Their number of movies and shows they have is immense. They have a massive library, and they haven't quite figured out how to really turn that into profit, but if they do, that is a good margin business. So that, along with their parks, should get them possibly back to that 20-25% operating margin. They now pay a dividend again after not paying it for almost 5 years. It's a 1% yield, and return on invested capital was historically fantastic with those great operating margins, but with the recent dampening of those margins, you're looking at pretty poor return on invested capital. Their balance sheet does have some net debt here, so 14.1 billion in cash on hand, 4 billion short-term debt, 42 billion long-term debt. One good thing I'm seeing is 10 billion reduction, almost 11 billion reduction in long-term debt over the last 3 years. And cash on hand is a good amount, well above their short-term debt, but they do still have quite a bit of net debt here. So let's look at roughly 40 billion in relation to free cash flow is going to be a good amount. That is a pretty excessive amount of debt, but it looks like they have been paying that down quite a bit the last 3 years. So in our assumptions, we might have to assume that um, this is just this, we're going to have to assume some things here that are going to be a little bit different due to the fact that the last 3 years their capital allocation is just debt pay down. That's it, and they weren't even making that much money, and so that's going to be something we're going to have to balance with our assumptions, what they've done in the past, with what we want them to do. Over here, pre-COVID, they were paying a dividend, they were buying back a lot of shares, making some acquisitions, and recently we're just not seeing that. And so, will they go to those pre-COVID capital allocations? I'm not entirely sure, but let's base our assumptions off of what we think is going to happen in the future. So again, revenue growth, I think them growing at 5% is probably too conservative for me. I think 7% is pretty reasonable because again, you have the parks are growing like crazy, and I don't even know if they're quite at their pre-COVID levels, but that'd be a quick thing to look at if you were to look at their quarterly report. And then their growth on their streaming service, I think, absolutely still has some growth ahead of them. And they're just pretty decent at finding other opportunities to invest in. So 7% a year seems pretty reasonable to me. And I think 18 PE, I think there's very little moats out there that are as dominant as Disney. I think their dominance of so many things when it comes to, now they own Marvel, Star Wars, the Mickey Mouse, all that Disney Channel stuff. I mean, they just have a huge dominance there. So I think I'm fine with 18. Maybe you think higher, but they do have a little bit of net debt. So maybe I'll go 19 here. If they didn't have any net debt, maybe a 20, 21, 22, I think could be fine. But again, I'm definitely more on the conservative end, I feel like. But either way, I'm going to say that they don't necessarily go to those pre-COVID margins, but they get close. And I think if they get close, you're probably looking at 12, 10% margins here with a share change of I mean, they'll just pretty much offset stock-based compensation. I feel like that's pretty reasonable. The dividend, haven't really done it for very long, so fine keeping that the same. So really, these assumptions are assuming that they get back to making almost 900 or $9 billion a year at the end of the 7-year period. So that's going to assume that a little bit of the money goes to share repurchases, the dividends not paying out too much, and then they find ways to make acquisitions and reinvest to get back to those, to make the company more efficient, to get back to those margins. And we're saying it needs to fall 27% before you get the return we're looking for here. So pretty big company for it being as close as it is, and a company that I think I'd be absolutely baffled if it went away, if the business didn't exist in 10, 15 years, honestly. Honestly, 20 years, I could even see them like still be dominant since they just have so much material in their library. So for me right now, it doesn't look like an obvious deal, but it looks like it's honestly fairly close. Hope you enjoy the video of yours today.